Okay, well, I do want to make sure I get to the other side, which is
Ooh.
very common, right? This is going to be the average portfolio. I had John Harbison on this show. He's at TC Adventure Group, one of the most data-driven investor communities. Had amazing data on this show to talk about how in the first 5 years, most of your outcomes are going to be, shutdowns or 1x or around that, and then it's in the year 5 to 10 plus that the winners really start to show up. So, walk me through some of the things that you've found many angels aren't thinking about or aren't as familiar with, and how they can optimize some of those shutdowns, because there are benefits with a shutdown with a loss.
Such a bummer topic. Such a bummer topic. Um, let's assume that none of your audience members are going to need to know this, but let's tell them about it. So let's go back to if I have an account of like Charles Schwab or something, like I bought, whatever. I bought Bitcoin at this, and now it's worth way less, hasn't gone to zero, uh, yet. No, just kidding. Uh, if you sold it at a loss, it's a capital loss. Everybody is allowed to take those capital losses and use them on your taxes. It ends up helping actually. Capital losses, if you don't have other things to like offset it with, the most you can take in any one given year is $3,000 in one given year. So if I lost like, we'll keep it easy, we'll keep it nice. If I just lost my $10,000 in like one deal or one check, I could write off $3,000 in that one year, and then the other seven, I don't lose forever. You just have to like kind of roll them, keep carrying them forward until you burn them up. Basically, that's the normal rules. Capital losses, like everybody gets those. For startup investing, there is a special line of tax code. Um, we'll just lovingly call them 1244 losses. So 1244, another code, IRS tax code, right? This is not really related to state taxes. Um, and this says that if you were an early investor in a startup, and it hit a few like thresholds, they're little bit different than the QSBS like criteria. But if you had a few different criteria and then you lost and it went to zero, you can write those losses off as ordinary income losses,
Mm.
which is way juicier than capital gains. I think I was saying capital gains rates, even on the high side, like 23.8%. Ordinary income can be, up to almost 40%. And what you can write off you can write off more than just like 3,000 in a year. These limitations are what you're allowed to write off. I'm double checking my numbers to make sure I don't say the wrong one because we're throwing around a lot of numbers, but basically $50,000 per person. And that's important because in this case, if you're married, you get 100,000.
Hmm.
And so, it's a lot of losses, a lot of losses, but you can get up to $100,000 off if you write it off against your ordinary income,
To my
which is,
personal family, joint return.
yeah, just normal income, just against your normal income. So that's great. Uh, the big things are, let's see, I'm trying to get the exact language, but at the time the stock was issued, or the time that you invested at that time, the corporation itself, and I think this can actually be a C corp or an S corp. But the rules are changing. Um, the corporation must have received less than $1 million in exchange of the stock. Meaning they have raised less than $1 million. So if they're doing a mega raid and we're raising $4 million this round, like too big. But if they're like a lot of groups and they're only raising like, you know, to 500K or something like that, you're still considered small for this. this line of tax code doesn't use like the qualified small business lingo, so you're not gonna see the word small business, but that's their definition of small.
It's
In
under
this
$1 million
case,
raised, essentially.
raised. Correct. Yes. So that one is probably like this is how it always goes. We spend all the time talking about like the really like sexy romantic one because then like it's very juicy and attractive to go after. The reality is that most angels should be paying attention to 1244 losses. The punchline with all of it is if you are going through any exit at all, or you're about to, you see the writing on the wall, it's time to get your ducks in a row and make sure you have any documentation for anything because you're going to have to prove that you wired the money in. You have to prove what size the company was at the time, which all goes back to QSBS, or I guess in this case, 1244 protocol for angels, which we all desperately need. And you really don't want to be scrambling around tax time to find information that maybe doesn't exist anymore.